If you tell an investor that you're going to hit a 14% IRR and you don't execute on your leasing assumptions, you didn't just miss a goal, you actually broke a promise. Investors have options. They can choose to invest in stocks and bonds and art, even in cryptocurrency, and they're investing in commercial real estate for an outcome. Today, I'm going to be talking about how a leasing associate's work actually affects that outcome and how getting leases signed in January as opposed to December of the same year actually makes a big difference. I'm Hugh Chen, president of Saglo Companies. We own and operate shopping centers across the Southeast and Mid-Atlantic. And my goal is to bring 100 people into the retail shopping center industry. So if you are thinking about coming in, please listen up. Now, we can't take for granted that we have investors. And investors are looking for really two things. They're looking for yield and they're looking for IRR. The yield part, think of it as cash on cash. It's like a dividend. What do you get paid every month or every quarter or every year in cash dividends distributed to the investor? Now, the IRR is really the big picture of your return, including the appreciation. So it's a long-term return. If your average yield is 10% and your IRR is 14%, the difference, which is the 4%, is actually your appreciation. If you think about it, that's what you created through your smart operations and leasing. Now, if you fail to deliver those IRRs and those yields to the investors, guess what? The capital ends up going elsewhere. Leasing teams love to say that, hey, I'll do 20 new deals this year. But from an investor standpoint, when you do those deals within that year, really make a difference. Where a new deal that's signed in January with a rent start in March, you're getting 9 months of income for that lease. But a lease signed in December of that year, you're not getting any income for that calendar year. When we underwrite a shopping center to acquire at Saglo, we make market leasing assumptions. Our job after closing is to actualize those assumptions. So speed is a variable of value. As a leasing associate, you are directly impacting NOI. You are the engine of value creation, of income generation. You directly impact gross revenue, and you also directly impact the cap rate. If you bring a tenant at a really high rent, you might have thought that you won, but perhaps if that tenant is a little bit shaky and doesn't make it, if the rents aren't replaceable, if you don't have a lot of durability and income with that tenant, and a lot of buyers don't think that that tenant will continue to pay rent throughout that term of the lease, guess what? They're going to underwrite and give you not full value for that income. It could actually be a little bit of a value trap. The work is about hitting the numbers that you promised when you were underwriting the deal and making those assumptions. All right, hope this helps. Drop some comments and questions below. I'm happy to answer them.